Ladies and gentlemen, we need to stop pretending this is just another market anomaly, because what you are watching right now is not a temporary disconnect. It is a fracture, a clean break between two worlds that are no longer moving together. On one side, you have the paper price flashing on screens, calm, orderly, pretending everything is normal. On the other side, you have the physical metal, disappearing, being locked up, pulled out of vaults, bid for aggressively by people who don't care what the chart says. And that contradiction should make you very uncomfortable. Because markets can lie for a while, but logistics cannot. You can print contracts, you can roll futures, you can settle in cash, but you cannot fake physical flow forever. And right now, the flow is screaming something that the price is not allowed to say out loud. This isn't volatility, this isn't speculation, this is confidence quietly leaving the paper system. Ask yourself this: if paper and physical were still the same market, why are they behaving like enemies? Why does price say abundance while inventory says scarcity? Why does every dip trigger more buying, not less? That's not how healthy markets behave. This is the moment most people will miss. Not because it's loud, but because it's subtle. And by the time it becomes obvious, the split won't be debatable anymore. It will be irreversible. To understand why the paper versus physical split is no longer a temporary distortion, you have to understand how the two markets actually function, and more importantly, how they are allowed to drift apart without immediately collapsing. On the surface, we are taught that price is price, that a single number represents supply and demand, but that assumption only holds when paper claims can be reliably converted into the real thing. Once that confidence weakens, you no longer have one market, you have two. The paper market is built for speed, leverage, and liquidity. Futures contracts, options, ETFs, swaps, these instruments exist to allow exposure without ownership. They trade enormous volume without moving a single ounce of metal. That structure works beautifully in calm conditions, because most participants never intend to take delivery. They just want price exposure. As long as everyone believes delivery is possible if needed, the illusion holds. The physical market is built for something entirely different. It is slow, logistical, and constrained. Metal must be mined, refined, transported, insured, stored, and delivered. It cannot be created on demand. It cannot be rehypothecated infinitely without consequence. When stress enters the system, the physical market doesn't respond with volatility. It responds with hoarding. This is where the split begins. In a healthy system, paper price leads and physical follows. Arbitrage keeps the two aligned. If paper gets too cheap, physical buyers step in. If physical gets too expensive, metal flows back into the system. That loop depends on one thing: trust. Trust that paper claims represent access to real metal. Trust that settlement will occur without friction. Trust that supply can move freely. That trust is now eroding. When paper markets experience stress, margin calls, forced liquidations, volatility spikes, price can fall violently without any increase in physical supply. No mines suddenly produce more silver. No warehouses overflow. The drop is purely financial. And that is where the divergence becomes visible. Physical buyers don't see lower price as weakness. They see it as a temporary mispricing caused by dysfunction elsewhere. At the same time, arbitrage begins to fail. Not because traders are asleep, but because the pathways are clogged. Delivery timelines stretch. Export restrictions appear. Inventory is spoken for. Premiums rise even as spot falls. That's the tell. When spot price drops, but premiums rise, the paper price has lost authority. Paper markets can clear by cash settlement. Physical markets cannot. You either have the metal or you don't. And when more participants want metal than there is available to deliver, the market doesn't clear through price. It clears through exclusion. Some buyers simply don't get filled. This is why volume becomes misleading. Paper volume explodes during stress because contracts are being dumped and rolled. Physical volume often shrinks because holders refuse to sell. They don't need liquidity, they need certainty, and certainty does not come from a screen. Once enough participants internalize this distinction, behavior changes permanently. They stop using paper price as a signal for value and start using it as an opportunity for acquisition. That is the psychological shift that makes the split irreversible, because now every paper smash accelerates physical drain. The system tries to restore order the only way it knows how: through liquidity injections, regulatory tweaks, or jawboning. These tools can stabilize prices temporarily, but they do nothing to increase physical supply. In fact, they often make the problem worse by reinforcing the idea that paper price is being managed. The more the paper market is supported without addressing the physical imbalance, the less credible it becomes as a price discovery mechanism. Participants don't rebel loudly. They simply disengage. They stop selling. They stop trusting. They start removing metal from circulation. And that's the critical point. This split doesn't announce itself with a collapse. It creeps. It widens quietly. It becomes obvious only in hindsight when reunification is no longer possible without structural change. To repair the split, you would need metal to flow back into the system, not contracts, not cash, not credit, actual ounces. And that is where the process breaks down, because the conditions that cause the split also discourage holders from parting with their metal. Why sell into a system that has already shown it can disconnect price from reality? This is why the idea that paper price will eventually pull physical back into alignment is backward. Once confidence breaks, physical leads and paper chases. And paper always lags because it cannot compel delivery, only participation. We are now past the point where this is a trading opportunity. It is a structural condition. Two markets, two logics, two definitions of value, one driven by leverage and settlement conventions, the other driven by scarcity and necessity. And the longer this persists, the harder it becomes to reverse. Because every day that metal stays out of circulation is a day that reinforces the new equilibrium. The split is not dramatic. It doesn't require a headline. It only requires enough people to stop believing that a paper claim is equivalent to ownership. That threshold has been crossed. What you're watching now is not a divergence waiting to be corrected. It's a system adapting to the realization that the old alignment no longer serves everyone equally. And once that realization takes hold, price is no longer the referee. Metal is. If price tells a story, flow tells the truth. And when you stop listening to headlines and start watching where the metal is actually moving, the paper versus physical split stops looking theoretical and starts looking undeniable. Because metal doesn't argue, speculate, or explain itself. It simply goes where it is most needed. And right now it's leaving the system that claims to price it. Every structural break in a commodity market begins the same way. Inventories start behaving differently than price. Vault reports show steady withdrawals that don't reverse after sell-offs. Exchange stocks decline even during periods of supposed weakness. Metal that used to cycle in and out of storage stops coming back. That's not coincidence, it's intent. When physical silver is pulled from vaults, it rarely returns. Unlike paper positions, physical ownership has no expiration date. Once a bar leaves the system, it's either going into industrial use, sovereign reserves, or long-term private storage. None of those categories respond to short-term price signals. They respond to risk. This is why withdrawals accelerate during volatility. Price drops trigger fear in leveraged participants, but they trigger opportunity for those focused on supply security. Industrial users don't care about daily charts. They care about continuity. Sovereign buyers don't chase momentum. They preempt disruption. And private holders who have already seen paper markets malfunction are not eager to sell back into the same system. This behavior shows up most clearly in premiums. Premiums are the pressure gauge of the physical market. When they rise during price declines, it tells you demand is insensitive to paper weakness. Buyers are paying more to secure metal even as the quoted price falls. That is the definition of a broken pricing mechanism. At this stage, arbitrage is supposed to step in. In theory, traders buy cheap paper and sell expensive physical, restoring balance. In practice, that only works if physical is available, deliverable, and mobile. But when inventories are spoken for, delivery times stretch, and export controls appear, arbitrage becomes a theoretical exercise rather than a practical one. This is where the system quietly changes rules. Cash settlement becomes more common, position limits are adjusted, delivery incentives are modified. None of this increases supply. It just reduces the probability that paper claims will ever need to be converted into metal. That's not price discovery, that's damage control. Meanwhile, the flow continues. Metal moves from visible inventories into opaque ones, from exchanges into private vaults, from sellers who need liquidity to buyers who prioritize certainty. And once that transition happens, the metal is effectively removed from the price-setting mechanism. It no longer responds to futures curves or technical signals. It responds to real-world demand. This is why physical markets often appear quiet right before repricing events. There's no frenzy, no panic buying, just steady accumulation. The absence of selling is what matters. Supply doesn't need to vanish completely. It just needs to stop being elastic. And elasticity is the key concept here. Paper markets are infinitely elastic. New contracts can always be created. Leverage can always be increased until it can't. Physical markets are inelastic by nature. You can't conjure new supply in response to demand spikes. When demand overwhelms available metal, price doesn't move smoothly. It gaps. That's why following the metal matters more than following the chart. Charts show consensus. Flow shows conviction. Every ounce that leaves the exchange reduces the system's ability to maintain the illusion of abundance. Every bar that goes into long-term storage raises the bar for future delivery. And every buyer who insists on physical, rather than exposure, is voting against paper price authority. This process feeds on itself. As inventories decline, remaining holders become less willing to sell. As willingness to sell drops, price sensitivity increases. As price sensitivity increases, paper markets become more volatile. That volatility, in turn, drives more participants toward physical ownership. That feedback loop is what makes the split irreversible. At no point does the system announce that price discovery has failed. It simply becomes less trusted. And trust, once lost, is not easily regained. You cannot legislate confidence back into existence. You cannot print metal. You cannot force long-term holders to sell at a price they no longer recognize as legitimate. This is why focusing on daily price action misses the point. The real signal is persistence. Persistent withdrawals, persistent premiums, persistent refusal to sell. Those are not speculative behaviors, they are defensive ones. And defensive behavior in a commodity market is the precursor to repricing. When the physical market finally asserts itself, it doesn't do so gradually. It does so through scarcity shocks, through delivery failures, through sudden changes in availability that no amount of paper volume can offset. By the time price reacts, the flow has already done its work. So if you want to understand where this market is heading, stop asking where price is today. Ask where the metal is going. Ask who is accumulating quietly. Ask why supply is becoming less responsive even as paper claims multiply. Because metal doesn't lie. And right now it's telling you that the system is no longer balanced. It's bifurcated. Two markets, two truths, and only one of them ends with delivery. At this stage, the most important question is no longer whether the paper and physical markets have split, but whether that split can be repaired. And this is where the uncomfortable reality sets in. Fixing it would require reversing the very forces that created it, not managing them, not smoothing them over, actually undoing them. And that is why the split isn't just persistent. It's structural. To bring paper and physical back into alignment, the system would need to restore confidence in one core promise, that paper claims can be converted into metal at scale, on demand, without friction. That promise is what allows paper markets to set the price in the first place. Once enough participants doubt it, the authority of paper pricing begins to erode. The problem is that every tool used to stabilize paper markets undermines that confidence further. Liquidity injections stabilize price, but not supply. Cash settlement resolves contracts, but avoids delivery. Position limits reduce visible stress, but concentrate risk elsewhere. Each intervention may prevent immediate disorder, but none of them put metal back into circulation. In fact, they often send the opposite signal, that the system prefers accommodation over fulfillment. This creates a paradox. The more aggressively paper markets are protected, the more attractive physical ownership becomes, because protection implies fragility, and fragility is exactly what physical buyers are trying to hedge against. Even if authorities wanted to force reunification, the math doesn't work. Physical silver supply is constrained by geology, production timelines, and competing demand. You cannot suddenly increase output without years of investment. Recycling responds slowly and only at much higher prices. Meanwhile, paper exposure can expand instantly. That asymmetry guarantees tension. There's also a behavioral barrier that cannot be overcome with policy. Once holders of physical metal decide that paper price no longer reflects value, they become price-insensitive sellers. Or they stop selling entirely. This reduces available float, and reduced float amplifies every future demand shock. In past cycles, this was solved through price. Higher prices enticed metal back into the system. But that mechanism depends on trust that price will be allowed to rise freely. When participants suspect that upside will be capped or managed, the incentive to sell disappears. Why part with metal at a price you believe is artificial? This is where attempts to suppress volatility become counterproductive. Volatility is how markets clear. By smoothing it, the system prevents natural rebalancing. Stress builds beneath the surface until it releases elsewhere, through inventory drains, premiums, or sudden shortages. Another obstacle to repair is global fragmentation. Physical silver demand is not centralized. It spans industries, nations, and strategic reserves. Metal moving into one jurisdiction may never return to another. Export control, strategic stockpiling, and regional supply chains break the idea of a single unified market. Paper markets, by contrast, assume fungibility and mobility. Contracts don't care where the metal is, only that it exists somewhere. Physical buyers do care. They care deeply. Location matters, access matters, jurisdiction matters. And once those concerns dominate decision-making, paper abstractions lose relevance. There is also the issue of precedent. Every time a market survives stress through cash settlement or rule changes, it teaches participants a lesson. The lesson is not that the system is strong, it's that delivery is optional. Over time, optional delivery becomes expected non-delivery. At that point, paper claims cease to function as proxies for ownership. Rebuilding confidence after that shift is extraordinarily difficult. It would require not just honoring delivery, but over-delivering, proving reliability under pressure. That means allowing shortages to surface, allowing price to rise, allowing volatility to express itself. In short, allowing the system to be uncomfortable, and that is politically and institutionally unattractive. So instead, the system adapts by bifurcating. Paper markets continue to exist as financial instruments. Physical markets continue to exist as logistical ones. They reference each other, but they are no longer governed by the same rules. This is why calling the split temporary misunderstands its nature. Temporary distortions are resolved by arbitrage. Structural splits persist because the incentives to close them no longer align. Every attempt to force convergence through price suppression accelerates divergence through physical withdrawal. Every assurance that there's plenty of supply is contradicted by behavior. And behavior, not statements, is what markets ultimately respond to. At some point, the system stops trying to fix the split and starts managing around it. That's when it becomes irreversible. Not because of a dramatic failure, but because no one believes reunification is worth the cost. The paper market will continue to function, but as a reference, not an anchor. The physical market will continue to accumulate metal, but outside the price-setting mechanism. And once those roles are established, they don't swap back. What you're witnessing now is not dysfunction in motion, it's adaptation. A system learning how to operate after trust has thinned. Two markets coexisting uneasily, each serving different needs. One trades exposure, the other holds reality. And no amount of intervention can make those two things the same again. This is where the consequences of the split stop being abstract and start becoming unavoidable. Because once paper and physical are no longer governed by the same logic, price itself changes character. It stops being a discovery mechanism and becomes a lagging indicator. And history shows that when price lags reality for too long, it doesn't adjust smoothly, it resets. Paper price always reacts last, not because it's slow, but because it's insulated. It's cushioned by liquidity, leverage, and policy intervention. It can ignore stress longer than physical markets can because it doesn't have to deliver anything tangible. But that insulation comes at a cost. When adjustment finally happens, it happens all at once. This is why every major repricing event in commodities looks sudden in hindsight. For long stretches, price appears calm, even contradictory. Fundamentals don't matter. Warnings are dismissed. Then, in a very short window, the market gaps into a new regime. Not because something new occurred, but because something old finally broke. In a split market, the trigger is never bullish enthusiasm. It's constraint, a failed delivery, a sudden shortage, a buyer who needs metal now, not exposure. When that buyer shows up in size and discovers that paper promises can't satisfy physical needs, price is forced to reconcile with reality. And that reconciliation is violent. The reason is simple. Paper markets are built on the assumption of elasticity. That assumption allows enormous positions to exist relative to actual supply. When elasticity disappears, those positions scramble for exit at the same time. Liquidity evaporates, offers vanish, price doesn't climb, it leaps. This is why waiting for confirmation is dangerous. By the time paper price confirms what physical markets have been signaling for months or years, the opportunity has already passed. The move doesn't start at fair value. It overshoots it, because the system has to compensate for time spent mispricing risk. Another critical point most people miss is that repricing doesn't require universal participation. It only requires marginal pressure in the wrong place. One stressed delivery cycle, one industrial buyer refusing cash settlement, one sovereign decision to secure supply outside the open market. These are small actions in isolation, but in a tight system, they have outsized effects. Once that happens, the narrative flips instantly. The same analysts who dismissed the split will rush to explain why price suddenly moved. New stories will be written, new justifications will appear, but none of them will mention the months or years of quiet physical accumulation that made the move inevitable. This is also where the psychological damage of the split becomes evident. After repricing, trust does not automatically return. Participants remember who was protected and who was not. They remember whether delivery was honored or avoided. They remember whether price was allowed to function or managed into submission. As a result, physical holders become even less willing to part with metal. The very act of repricing confirms their suspicions. Supply becomes tighter after the move than before it. This is why post-repricing markets often remain volatile and elevated for longer than expected. The system has lost its release valve. From that point forward, paper markets no longer lead behavior. They follow it. Futures curves adjust to availability rather than sentiment. Price becomes reactive instead of directive. And the idea that paper exposure is the same thing as ownership quietly dies. None of this requires collapse. No headlines are necessary. No declarations are made. The transition is recognized only by those paying attention to flow, not noise. The final irony is that when the split becomes undeniable, it will be described as obvious in hindsight. People will say the signs were always there, and they were. The only reason they were ignored is because acknowledging them would have required questioning the foundation of modern market structure. So the real takeaway isn't about timing the next move. It's about understanding where authority now resides. Price on a screen no longer commands metal. Metal commands price. It just hasn't spoken loudly yet. When it does, it won't ask for permission. The paper market will adjust because it has to. The physical market won't because it doesn't need to. That's what makes the split irreversible. Not drama, not panic, not conspiracy, just the quiet realization that exposure and ownership are no longer interchangeable and never will be again. And by the time that realization becomes mainstream, the reset will already be complete.